I've given presentations similar to the one I'm going to do tonight several hundred times on 5 continents all over the world, and they're typically in the morning or the afternoon. This is only the second time I've done this in the evening, and the first time was in Kuwait, which is a dry country. There's no alcohol, so I think this is literally the first time I've done this presentation where the audience had a head start on me in terms of margaritas or making it to the bar. So I don't know if that's a good thing or a bad thing. We'll find out. But I'm certain it will encourage the dialogue and the conversation. So I'm looking forward to that. We've got a lot of material to cover. We're going to bang through it. But at the end, I'm going to leave time for questions because that's usually the part that people are most interested in. I know I get a lot out of it, just hearing questions from people around the world. It really teaches me a lot about what's on people's minds. Also tomorrow, around, I think beginning around 7:30 or so, we're going to have there's a separate opportunity, sort of informal, just be around and interacting with folks. So I look forward to that as well. Looking forward to meeting with people. I'll probably arrive a few minutes after 8. I think the formal start is 7:30, but you can check with Andrew for details on that. But between our Q&A tonight and our informal get-together tomorrow night starting at 8, I hope to have a chance to meet all of you over the course of the next day or so, and I do look forward to that. So this conference is primarily about offshore strategies. That can be bank accounts, it can be passports, it can be other wealth preservation mechanisms. Some of them have a tax aspect, some of them have a liability management aspect, offshore trusts, if you're worried about litigation, et cetera. I know a little bit about a lot of those things, but that's not my main area of expertise, and that's not mainly why I'm here tonight. I think all of your other speakers are here to shed some light on that and answer some of your questions. My purpose tonight is to give you some reasons why you might want to be interested in that. In other words, if everything were fine with the dollar, if everything were fine with the U.S. tax system, if everything were fine with the U.S. economy, U.S. governance, if all those things were wonderful, I don't think very many people would be thinking about offshore strategies. The fact is they're not wonderful, at least not in my view, and some of these changes are structural to the point where the more time goes by, the more doubtful you are about the ability to fix them. I never give up entirely on the process, but we do seem to be at a point of diminishing, if not negative, marginal returns on a lot of what's going on with the U.S. government. So my role is really to point out some threats, point out some dangers, point out some vulnerabilities. Taking all that together, you're in the best position to know what you want to do with your wealth and your income and manage that. But this will hopefully give you some helpful background in thinking about that. So we have a nice cheery title, The Death of Money, the Coming Collapse of the International Monetary System. But with that, we can jump in. In 2009, I was asked by the Pentagon, the Department of Defense, to help plan and later participate in the first ever financial war game. Now, the Pentagon does war games all the time, and they don't need any help from me on that. But this was the first time they wanted to have a financial war game. And what that means is that the only weapons that you could use would be stocks, bonds, commodities, derivatives, foreign exchange, et cetera. So you couldn't shoot any missiles or use any submarines or aircraft carriers or drones or anything of that sort. It was strictly financial weapons. But it was designed, it wasn't a normal economic scenario of the kind we sort of see play out in markets every day. This is one where it was actually a war, and you were trying to weaken or destroy your enemy or your adversary using financial weapons. And how would you do that, and what would that look like? So that was what we did. It had never been done before, so we had to, first of all, write the rule book before we could play the game. I called it Playing Risk for Adults, if you know the old board game by Parker Brothers. And as I say, I was brought in for the Wall Street expertise. We had, in the end, we had about 100 participants in a very large war room at the Applied Physics Laboratory. That facility on the right, you see, that's the Applied Physics Laboratory. It's a top secret weapons laboratory about halfway between Washington and Baltimore. So that's where we conducted it. And they host a lot of war games. So they had a big room with all the screens and everything. This is from the fictionalized version, Dr. Strangelove. But we had uniformed military. We had 3-star generals. We had people there from the FBI, Homeland Security, CIA, Treasury, Federal Reserve, a lot of think tank people. And one of the things I did, one of my contributions, was to say, look, if we want to make this realistic, I wanted to be able to recruit some people from the private sector. I said, if we're going to play a war, I mean, wars are all about, lies and manipulation. Who knows more about that than Wall Street? So I was able to invite some of my colleagues, one fellow from UBS, another fellow who had run a Russian private equity fund, to join us. We played it over a couple days. And I write about this in my first book, Currency Wars. This is the first 2 chapters of Currency Wars. We launched a scenario, and I'll bear in mind this is 2009. We launched a scenario in which Russia and China conspired to take all of their gold, put it in a vault in Switzerland, set up a bank in London, and that bank would issue new currency, new money, obviously electronic, but new form of money backed by the gold. And the kicker was, they said, from now on, if you want Russian natural resource exports or Chinese manufactured goods, you can only pay for it in this new money. And if you want to know where to get the new money, there are 2 ways to do it. You can trade with us and earn some. That's the way any country earns foreign exchange reserves. Or you can put your own gold in the depository and go to London and get some of the currency. The bank will issue new currency. In other words, a brand new gold-backed currency launched by China and Russia with others invited to participate. And the purpose of this was to run the dollar off the road, to basically pull the rug out from under the dollar as a store of value medium of exchange, obviously threatening the national security interests of the United States. Now, a couple things. We knew this wasn't going to happen tomorrow. We knew it wasn't something that was going to happen the next day. But the whole point of a war game is to think outside the box. So as I put it, give the Pentagon their money's worth, lean forward a little bit, and talk about threats that are maybe over the horizon but heading your way. Fair to say we were actually laughed at when we launched this scenario. I'm sure we have some Harvard graduates in the room, but one of the Harvard professors just laughed out loud. He said, "This is ridiculous. Why are you wasting our time on this scenario? Everybody knows gold is not part of the international monetary system. It never will be again. It has no value. This is basically a waste of time. You get a lot of talented people in the room. You're wasting our time." And when we launched the move, of course, this is all done. You take turns and you caucus with your group at embassies, and you come out and you announce your move, and then other people get to react to it. It's a fairly sophisticated interaction. There's one cell, you have colored cells, so the red cell, the blue cell, the green cell. That was like Russia, China, the United States. But the white cell are the referees, just like in a football game, and they get to declare, they award power points or take them away depending on the progress of the game. And they actually made a ruling. They said, when we announced it, they said, this is an illegal move. You can't do this. And we jumped out of our seats. We said, what do you mean illegal? It's a war. What's legal or illegal? We should be able to do whatever we want. And it's sort of like in the NFL where they say, upon further review, and they came back and said, no, okay, we'll let you do it. It's a legal move, but it's a stupid move. And so we said, okay, let's just play it out. But it played out over a couple of days. When I got home from it, after a couple of days, I said to my wife, I said, it was fun. I have good news and bad news. The good news is my team won. Bad news is I was China. So anyway, so that played out. It's all in the book. But my point is, here were some of the top financial experts in the world laughing at us about introducing a gold scenario in a strategic context. Since 2009, Russia has doubled its gold reserves. They've gone from about 600 tons to about 1,200 tons. China has increased its gold reserves several 100%, from 1,000 tons to some number, probably close to 4,000 tons, maybe more. No one knows the exact number because they do it in stealth. They lie about the reserves. They say they have 1,000 tons. No one knows how many tons they have. But we have enough data from mining output, Hong Kong imports, other data to come up with an estimate of what they have. So Russia has doubled its gold reserves. China has increased its reserves 300 or 400%. In other words, they're acting exactly the way we described 5 years ago when we laid out this scenario. So looking back on it, I think we did a pretty good job of raising the alerts. And actually, interestingly, one of the powers that's sort of come out of nowhere to get gold is Turkey. They now have over 600 tons, which is significantly more than UK, even though Turkey is a much smaller economy than the UK. So you can see an emerging Russia, China, Turkey, Iran axis built around gold, and you can see that it's kind of leading up to this, even though it may still take a few more years to play out. But there's one where I think we did a forward-leaning scenario, but subsequent events have validated a lot of what we said. Meanwhile, we have a couple threats to the dollar today. Again, what I just described was a war game, but apart from the war game, there's the real world, and we are actually in a financial war today with Russia. You can call it economic sanctions. imposed. You know, Russia invaded Crimea. They are in the process of peeling off a couple of republics in eastern Ukraine. Nobody thinks it's a good idea to send in the U.S. military. Nobody's going to put boots on the ground in Sevastopol. That's not a good idea. But the U.S. did not want to be seen to be doing nothing, so we responded with financial sanctions, which is a form of economic warfare. We had done this earlier to Iran with a lot of success. Between 2011 and 2013, we fought a financial war with Iran. We kicked them out of the dollar payment system, which we control. That's called Fedwire. Subsequently, we kicked them, and then the Iranians said, who cares? We'll just trade in euros or Swiss francs. There's another payment system called SWIFT that handles dollars plus all those other currencies. We prevailed on our allies to kick Iran out of SWIFT. Now, that was a really big deal because now Iran, they could ship oil, do whatever they wanted, but they couldn't get paid. There was no way to wire transfer any hard currency to an account for Iran. So Iran did a couple workarounds. They put dollars on deposit with China and Russia, and then China and Russia kind of fronted for them in the SWIFT system without revealing the actual beneficiary, which is illegal, but who cares? No one's really going to enforce that against Russia or China. They could do other things. They could ship oil to India, and then India could pay them in rupees in an Iranian bank account set up in an Indian bank, so they could get paid rupees. But what goes to the rupee? I mean, I'm not sure how much curry the Iranians need, but there's probably a limit on what you could actually do with a currency like that. So the point is, this was really threatening Iran. Now, what happened was the Iranian people, who are kind of natural merchants, pulled all their money out of the bank and went to the black market to buy dollars in the black market. So the Iranian rial collapsed relative to the dollar. The Iranian banks had to put up interest rates to 20% to stop the run on the banks. They help pay a lot of money to leave your money in the bank. This all caused hyperinflation. By the way, where were the dollars coming from that were being traded on the black market in Iran? They were coming from Iraq, because Iraq, actually, you can get dollars. You need a permit. It's not a completely open capital account, but there are a lot of dollars floating around Iraq because of, you know, the U.S. was at war there for about 7 years and put a lot of money into the place. So smugglers were bringing dollars from Iraq to Iran, selling them in the black market. The merchants were getting the dollars. They were smuggling the goods in from Dubai. You walk along Banias Road in Dubai, you can see all the things piled up with HP printers and iPhones. They like that stuff just as much as we do. But we were in the process of collapsing the Iranian economy. They had a currency collapse, run on the bank, hyperinflation, popular unrest. We were moving down the road to regime change in Iran without firing a shot. A very successful demonstration of financial warfare. In December 2013, the president called a timeout. He basically launched détente with Iran, removed some of the sanctions, not all of them, but enough to give Iran a lot of money. This is all about these nuclear talks that we're involved in now. So we sort of let them off the mat. The Saudi Arabians took this as a stab in the back. You're probably familiar with the so-called petrodollar deal from the mid-1970s, around 1974, when Henry Kissinger struck a deal with the royal family in Saudi Arabia that they would price oil in dollars. This was the last time the dollar was coming close to collapse. Now, there's no reason why oil has to be priced in dollars. You can price it in Swiss francs or Japanese yen, or today the yuan, then the Deutschmark, today the euro, or gold. There are a lot of ways to price oil. It doesn't have to be priced in dollars. But the Saudis agreed to price it in dollars. So what does that mean? Well, everybody needs oil, and if oil is priced in dollars, then everybody needs dollars. It forced countries to put dollars in their reserves, whether they like the dollar or not, because they needed the dollars to pay for their energy imports. So this was a very important prop under the value of the dollar. But there was a quid pro quo. The quid pro quo for the Saudis doing that was we would guarantee the perpetuation of the House of Saud. I'll call it their national security, but it's not really a nation, it's a kingdom. But in effect, we guaranteed their national security, and they agreed to prop up the dollar. When we launched this détente with Iran in December 2013, in effect saying, hey, we're leaving the neighborhood, we're pulling U.S. forces out of the Middle East, and Obama's foreign policy is to sort of leave a cop on the beat. So the U.S. will withdraw, but we'll appoint some major power in every trouble spot around the world and say, you're the cop on the beat, you keep things calm over here. We effectively anointed Iran as the regional hegemonic power in the Middle East, which is an existential threat to Saudi Arabia. So for the time being, they're still pricing oil in dollars, but they are actively considering ways out of this. China has become their largest buyer of oil because we never did buy a lot of oil from Saudi Arabia. Europe did. We get a lot of our We now have most of our oil domestically produced, and what we buy we get from Nigeria and Venezuela and a few other places. But it's a world market, and now the China-Saudi Arabia relationship is strong. So don't be surprised if you see oil priced in yuan. More likely SDRs, the special drawing right. We'll talk more about that later. So that's an important threat to the dollar. The other one, our friend Putin. Now, the U.S. put economic sanctions on Putin and Russia the same way we put them on Iran, but there's one very big difference. Russia has a much greater capability to fight back. Now we're in a realm that looks like, if you're familiar with the Cold War doctrine, the mutual assured destruction, this was the way the world ran for about 40 years, beginning in the late 1950s, and it worked like this. The U.S. had enough missiles, nuclear missiles, to destroy Russia. It was the Soviet Union, but I'll call it Russia because it's mostly Russia. We had enough missiles to destroy Russia. Russia had enough missiles to destroy us. That is an extremely unstable situation because the temptation is to shoot first. If you shoot first, the other guy is wiped out, you win. So what the two countries did is they built more and more missiles, what they call the second strike capability. So if the first side shot first, you could wipe out a lot of the missiles, but there'd be some left to shoot back, and then the guy who started the war would get wiped out too. We call this two scorpions in a bottle. One scorpion stings the other, the victim's going to die, but has just enough strength left to sting back, and they both die. That, believe it or not, sounds scary, but that was actually more stable than the first state of affairs. But this led to an arms race, which created its own problems. That was eventually settled through treaties. So that was called mutual assured destruction. We are now living in the age of mutual assured financial destruction, where when we launch economic warfare against Russia, which we've done, they can strike back and they can escalate. And you have to use a game theoretic approach. It's just like playing chess. You have to think through it 2 or 3 moves ahead. One of my concerns is that the White House is very good on offense. There's a fellow named David Cohen, who's an assistant secretary of the Treasury. He's in charge of financial warfare for the Treasury. President Obama, about a year ago, not quite, referred to David Cohen as my favorite combatant commander. You know, the combatant commanders, we have these joint commands around the world, Central Command, CENTCOM, PACOM, which is Pacific Command, and so forth. Well, to call a mid-level official of the Treasury your favorite combatant commander versus, you know, the guy who's the head of Pacific Command is a pretty big statement, but that's the way the president was thinking about it. He likes these financial tools. But I'm not sure the White House has thought very hard about the blowback, about the retaliation, including the fact that Putin can shut down the New York Stock Exchange. He could do that with ease. And people kind of roll their eyes and go, that's not true. And I said, well, what happened on August 22nd, 2013? The NASDAQ was shut for half a day. We've never been offered an explanation as to why it was shut. I suggest that if there were a plausible explanation, some technical glitch, they would have told us. And if it was an act of financial warfare, they would not have told us because they know they would panic the market. So the fact that we haven't been told at least implies that that was an act of financial warfare. Beyond that, recently, you go back June 27th, last summer, June 27, 2014, there was a cover story on Bloomberg Businessweek that in 2010, the FBI and Department of Homeland Security uncovered a Russian attack virus inside the NASDAQ operating system. This was not a criminal gang looking for credit card numbers. This was a sleeper virus put there by Russian military intelligence capable of shutting down the exchange. It was disabled, but how many more are out there? So my point is, you know, when the sanctions were tame, it was sort of like, okay, some Russian oligarch's going to go to the Super Bowl next year and his credit card's not going to work, or he's going to try to get a hotel in Geneva and he won't be able to use his American Express card. That stuff is pretty tame. But when you escalate, Russia can escalate back and people go, oh, well, you know, they shut down the New York Stock Exchange. We'll strike back. We'll shut down the Moscow Stock Exchange. Who wins? I mean, the Moscow Stock Exchange is irrelevant. It's almost a joke, right? So that's the kind of thing where they hit us where it hurts and our ability to strike back. This is what you call asymmetric warfare, where your ability to hurt them is nowhere near as great as their ability to hurt you, and that asymmetry favors them. There's not a military in the world, not one. And there's not even a combination that could go up against the U.S. military. We can sink any Navy, ground any Air Force, disrupt any command and control communication system in the world. So no one's going to fight us in that space because they lose. But when you're talking about cyber warfare, biological, chemical, radiological, and now financial warfare, that's a much more level playing field. So that's the warfare of the future. I only mention this, I'm spending time on this, because as if investors didn't have enough to worry about. You got to worry about inflation, deflation, we'll talk about some of these things, but these are an extra level of threats. This is one of the reasons, by the way, that I recommend gold for investors' portfolios. We can talk about the monetary and investment aspects of gold, but one of the things I like about gold is that it's non-digital, it's physical, you can't hack it, you can't erase it, you can't wipe it out with a few keystrokes. So it's one of those things that if the cyber financial warfare escalates and all of a sudden exchanges are shut down and banks are closed and accounts are wiped out and where's my money and et cetera, your gold is going to be sitting there. So I don't recommend all in, but a 5 to 10% allocation is probably a reasonable way to think about preserving wealth. I want to just spend a minute, not a long time, on the currency wars. They made a lot of news today. On days like today, I'm sure you all know the Swiss National Bank this morning broke the peg to the euro. They had for 3 years pegged their currency to the euro. They didn't want the Swiss franc to get stronger. There were enormous capital inflows coming into Switzerland. Everybody wanted Swiss francs because it was viewed as a sound currency. But you say, well, gee, what's the economy of Switzerland? Well, it's all exports and tourism. It's watches, precision machinery, chocolate bars, cheese, and skiing. So there's a little more to it. Pharmaceuticals. There's a little more to it than that. But the Swiss economy is dominated by exports and tourism. You get a strong currency, all of a sudden, I'd rather ski in France than Switzerland because France is going to be a lot cheaper. Or maybe I'll buy a German watch instead of a Swiss watch, as the case may be. So they had a reason for keeping a lid on the currency. The problem was the pressure was enormous, and they had to keep, because people wanted to sell euros, buy Swiss francs. So to maintain the peg, what does the Swiss National Bank have to do? They have to sell francs and buy euros. Well, to sell the francs, they print them. So they were printing an enormous amount of money, expanding their balance sheet, and they were going to end up owning all the euros in the world. The Swiss National Bank was going to be the Swiss National Bank of the euro because they had to keep buying euros to maintain the peg. Well, today they broke the peg. They said, we lose. Okay, so now the Swiss franc went up 40%, 40% in one day. They closed the exchanges, some of the foreign exchanges, Swiss franc was no bid. Now, the foreign exchange markets are the most liquid markets in the world, right? You have stocks, bonds, commodities, metals, there are all these markets out there. Some of them have more liquidity than others. The foreign exchange markets are, at least in the major currencies, the most liquid markets in the world. That market shut down this morning temporarily and it reopened with the Swiss franc 40% higher. Anyone selling volatility on Swiss francs to make a little easy money has probably been wiped out. I actually had calls from CNBC, Bloomberg, and RT to go on their shows today to talk about it. I said, sorry, I'm in Mexico. I'm nowhere near a studio. I'm just going to enjoy the beach, but I'll be on with them next week. But it's always interesting to me when the media want to talk about currency wars as if it just happened. And I make the point that we are in a currency war, but this started in 2010, and it's going to go for a long time. But the point is, a currency war is not the normal ebb and flow of exchange markets. That happens all the time. It happens every day. A currency war is different. That's not normal exchange rate adjustments. That's when a country intentionally devalues or revalues its currency for the purpose of changing its terms of trade with its trading partners, typically stealing growth from your other trading partners. The times when you have a currency war are when there's not enough growth to go around, such as today. We're in a global depression. I don't call it a recession. I call it a depression. And I can explain the meaning of that. A lot of people think, well, gee, if a recession is 2 or more quarters of declining GDP with rising unemployment, a depression sounds worse, so that must be like 20 quarters of declining GDP. And we don't have that because the fact the U.S. economy at least has been expanding since 2009. So they say, how could it be a depression? Well, the answer is that's not the definition of a depression. Depression doesn't mean continuous declining GDP. You can have growth in a depression. What makes it a depression is the growth is below potential. If your potential is 3.5%, which it is, and your short-run potential is more like 5% because you have a lot of underutilized labor that you can bring back into the workforce, and your actual growth is about 2%, 2.5%, which it has been since 2009, that gap, that delta between the 2% that you're actually doing and the 3.5% potential, or maybe 5% potential, that's depressed growth. That's what a depression is, a sustained period of below-trend growth with neither a tendency towards collapse nor a return to potential growth. By the way, that's John Maynard Keynes' definition. That's not my definition. I think it's a good one, but and that's the world we're in today. So when there's enough growth to go around, does the U.S. really care if some export country somewhere, suppresses its currency a little bit? No, we don't care. But today, we're fighting over crumbs. There's not enough growth to go around. Sovereign debt is too big. Everyone's trying to steal advantage from their trading partners. So we are in a currency war. It's actually the third one. There's a currency war that went from the early 1920s, starting with the German Weimar hyperinflation you've all heard about, that ran until 1936, and then eventually the suspension of the gold standard in 1939, and then the advent of World War II. There was a second currency war which started in 1967 with the devaluation of the pound sterling against dollars. Then, of course, we all know the famous episode, August 1971, when President Nixon, everyone says President Nixon took the U.S. off the gold standard. That's not technically correct. What he said, if you go back and watch his speech, and it's available on YouTube, he said, I am temporarily, of course, this is what, 44 years ago, he said, I'm temporarily suspending the redemption of dollars for gold. But technically, the U.S. never went off the gold standard, and this led to a series of negotiations, the Smithsonian Accord, the Plaza Accord, the Louvre Accord, that dragged on all the way through 1987. But finally, by 87, the countries had agreed on a set of exchange rates they were prepared to live with. And then we had very good growth in the 80s and 90s, and even in the early part of the 21st century. We're now in the third currency war, started in 2010. And this gets back to my point about the media's interest in this. They'll see something like the Swiss revaluation today, or the launch of Abenomics in December 2012, when Prime Minister Abe just said, we're going to print, December 2013, we're going to print all the yen it takes, whatever it takes. And people say, we're in a currency war. And I make the point, no, we've been in a currency war since 2010. We're going to stay in one for 5 or 10 or 15 years. So there are going to be more days like this. There are going to be more days when one currency breaks a peg or someone else decides to trash their currency. One of the interesting things we'll talk about in a minute is right now, every major currency in the world, with two exceptions, Swiss franc and gold. I treat gold as a currency, but take the Swiss franc and gold out and look at all the other currencies, the euro, the yuan, the yen, a lot of others around the world. They're all depreciating against the dollar. And the entire burden of global adjustment is being put on the US dollar. Remember how the currency war started. In 2010, the emerging markets were complaining that the dollar was too weak. They said we were cheapening the dollar to steal trading advantage, which we were. Today, in 2015, what are they complaining about? The dollar's too strong. So all the capital's coming out of the emerging markets. People are selling emerging market currencies, selling emerging market stocks, coming back to the US, buying US stocks. It's one of the reasons the stock market has been so strong. I know it's down 5 days in a row, but it has been very strong over the past year because of all these capital inflows. Don't ever look at trade. Trade inflows have very little to do with cross rates. It's really dominated by capital flows. And so that's what's going on. But this is typical of currency wars. In other words, it's not that one currency always goes down and another one always goes up. It's a seesaw. It goes back and forth like this. So in 2011, the weak dollar. 2015, the strong dollar. Guess what comes next? The weak dollar again. Because it has no resolution. Unless you have an international monetary conference, unless you have another Bretton Woods, unless you go to a gold standard, this is just going to keep going back and forth. So, your Wall Street analysts, they tend to extrapolate trends. Currency markets tend to overshoot. You'll come through a strong dollar period and say, oh, the euro's going to par, et cetera. Don't be so sure. That may reverse violently. So you have to be very, very nimble, and you have to look at the driving forces to understand these cross rates. But again, we talked about financial warfare being a headache for investors. Well, the currency wars are a headache for investors because you don't really know what your money's worth, at least in terms of other currencies. That's another space to watch. Bernanke, Ben Bernanke, chairman of the Fed at the time, in October 2012, had an interesting theory of currency wars. He said, look, the problem with currency wars in the 1930s is that they went sequentially. 1921, Germany destroyed their currency. In 1925, France destroyed their currencies in 1931. It was England. In 1933, it was the United States. In 1936, it was England and France again. This was the period of beggar thy neighbor currency devaluations. So Bernanke said it was that sequential nature that was suboptimal and caused all the difficulties. He said, I have an idea. Why don't we all trash our currencies together at the same time? And what he meant by that was let's all ease, let's all print money together. And if we all trash our currencies at once, the relative rates won't change very much. You won't have a currency war because he'll say we'll all get the benefit of stimulus, and we won't get a currency war because we're all printing money at once. So I analogize it to four guys jumping out of a plane, holding hands, except in this case, maybe they don't have parachutes. There were a couple problems with Bernanke's theory. The biggest problem is that Europe did not want to play, right? So the US was doing it, the UK was doing it, Japan was doing it, but Europe was not. They have not been using quantitative easing. They don't believe in it. The Germans don't believe in it. So they really control the European Central Bank behind the scenes. So he's missing one of the people who wasn't holding hands. That was Europe. But there's another problem, which is the world's a more interesting place. You've got the BRICS. The BRICS weren't included in Ben Bernanke's, instead of beggar thy neighbor, he called it enrich thy neighbor. But there were some neighbors who weren't getting enriched, which were the BRIC nations, who are getting more powerful and a much larger part of global GDP. So needless to say, as with most things Bernanke, there were a lot of flaws in the logic, but at least that's how the Fed was thinking about it. I want to shift gears a little bit and talk about a new branch of economics they call Fitzgeraldonomics in honor of one of my favorite authors, F. Scott Fitzgerald. And Scott Fitzgerald in 1936 said, the test of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function. A lot of emphasis on that last clause, still retain the ability to function. And investors need to do this today. You need to take two completely opposite ideas, get them in your head at the same time, and process them together if you want to understand what's going on in markets today. And what are those two opposed ideas? Inflation and deflation. They're both going on at the same time. The deflation is what I call natural. It's the state of the world. When you're in a global depression, things want to deflate. There are reasons for it. One of them is deleveraging. So I'm over-leveraged, so I sell assets, I get the money, and I pay off some debt, so I'm reducing my balance sheet, right? But what happens if I'm selling assets? It tends to lower the price. So that puts somebody else in distress. So